The quite opposite is happening in China. The Chinese economy is in shambles. They are, well, technically they're not in a recession, but their bond market is doing completely the opposite of what our bond market is doing. 180 degrees, okay? Completely opposite. Our bond market is raising rates, saying that inflation is coming back. The Chinese bond market is collapsing. When I say collapsing, the rates are collapsing, okay? And when bond markets price rates, interest rates, in such a manner that tells you where the economy is going to be 6 months ahead, that is something all of you need to watch, okay? Bond markets know best. You know, some of you may disagree, but in my past 30 years, I listened to the bond market. Bond market's larger than any market out there. And the bond vigilantes out there who hate inflation are pricing bonds correctly. In history, they have done it so, and it's worth paying attention to. You can't just go swing zero DTE options and then say, I'm fine, I'm fine. Well, that's a different story. But if you look at the macro picture in China, it is in shambles. Their real estate market is in shambles. It has been in shambles. Their manufacturing is slowing down. Well, now we have something else going against. It's another headwind. What is that? Trump talking about tariffs. Well, if China doesn't sell to us, their economy collapses, period. Because we have outsourced every single bit of manufacturing that we have in this country to overseas places, okay? China being the main one. So Chinese economy is in shambles. Every part of the Chinese economy, from their finance sector to their real estate sector to exporting, especially if the tariffs kick in. So therefore, the Chinese bond market is doing something completely opposite of what we're doing here, what our bond market is doing. If you guys can recall the chart that I showed previously, our bond market is raising rates. In fact, they have raised the rates by 100 basis points while the Fed is cutting the rates. Well, this is the Chinese bond market. The Chinese bond market, from 265, we are at 173. So China is facing the exact opposite situation as in the US. Their 10-year yield has collapsed nearly 100 basis points in 2024. And they're trying to stimulate. So FYI, Chinese debt to GDP is about 330%. Ours is at 130%, okay? But the Chinese bond market is saying the economy is definitely going to go in a recession, if not something worse. If the tariffs kick in, it may be worse, actually. And that's what the bond markets do. The bond markets don't take prisoners. They just take them in the back and shoot them. And China is nearing a recession. I think the Kobeissi letter is being very kind when it comes to the Chinese economy. I think they are in a recession. That's what the bond market's pricing, definitely pricing in a recession. I mean, look at this, right? Look at this trend. When the trend is your friend, when rates are collapsing like that, right? That means the economy is in shambles. And that's what the bond market is seeing. And that's what the bond market is expecting, massive amounts of stimulus in China. And China has started it already. China is cutting rates like we are. So the dilemma is the Chinese economy in a recession? And if the tariffs kick in, so I think there's going to be a lot of saber rattling coming up in January after Trump gets in the office. He is talking a big game, right? He's talking about tariffs to Canada, to Mexico, China. If we don't buy from China, who else is, right? There is some manufacturing happening around the globe, but we depend on Chinese goods. Well, that's the other thing that I'm seeing, that if the tariffs do kick in and exports become nil, basically, they will not buy from us because they will put tariffs on us as well. We're having a trade war, right? Not that we sell too much to China anyway, because our trade deficit with China stands about $650 billion a year at the moment. So if we have a trade war, who's going to get hurt, right? Well, Chinese economy is definitely going to get hurt, without a question. Well, the other party that's going to get hurt tremendously, as far as I'm concerned, is going to be the U.S. consumer, because we depend on cheap Chinese goods. When I say cheap, they're not as cheap as they used to be, but what it is that at least they can keep the inflation under control in this country. Well, if we put tariffs on, everything that we import is going to become more expensive. Well, when things become more expensive, what do corporations going to do? You guys think? What do they think? They're going to raise the goods. They're going to raise the prices. And raising prices is what? It's called inflation. And that's what our bond market is seeing and raising rates. So hopefully I'm trying to make some sense out of all this for you all. And the important thing is to understand these macro pictures.